Welcome to the Finance Podcast. The topic of this episode, India 2030, the silent giant on the path to superpower, by Colin Croft and Nilang Mehta, moderated by Young Sim Song.
So hello everyone, good morning. Welcome to the panel, India 2030, the silent giant on the path to superpower. I'm Young Sim Song. I'm a business journalist with the news agency AWP in Zurich, and I will host the panel today. We have 30 minutes for the discussion and around 10 minutes for questions from the audience. And with us on the panel today, we have Colin Croft from Jupiter Asset Management, who came in from London. And also we have Nilang Mehta, who is with HSBC Asset Management. He is based in Singapore, and he is connected to us today via video call. So, hello Nilang, could you please tell us a bit about what you do at HSBC?
Yeah, sure. Thank you for this opportunity. Good morning, everyone. I'm a lead portfolio manager for the HSBC's India strategy. It's one of the oldest India dedicated strategy, which we started in 1996. I've been with the firm since 2004 and have been associated with this strategy since 2009. In Singapore, we run the India offshore strategies. And I have a team of 2 colleagues based in Singapore, and a broader team is based out of Mumbai in India, where we have 14 analysts and fund managers based in Mumbai, and also team in Hong Kong, which support us in running these strategies.
Colin, 2 or 3 things the audience should know about your work at Jupiter Asset Management.
Sure. So at Jupiter, we have 2 India-dedicated funds. My colleague Avinash Vazirani is one of the longest-serving India-dedicated portfolio managers outside of India, with a track record stretching back to 1995. I've been at Jupiter for almost 20 years, and I've been working on the India product with Avinash for the last 5 years.
Yeah, thanks. So let's jump into the topic of the panel. Is India on the path to superpower, Nilang?
It's how you define being a superpower. So as you know, India is already the 5th or the 4th largest economy as we stand. It was the 4th, I think, with some currency moves. I guess it seems like 5th right now. But towards the end of the decade, it will be decisively number 3 in terms of the size of the economy, which it is. It would be currently it is $4 trillion US dollars. It could be upwards of 5 by then. Our Prime Minister has set a very ambitious goal of making India a developed economy by 2047, which is the 100th year of India's independence. And by then, the target is to make India a $32 trillion economy, taking the per capita GDP, which is around 2,800 US dollars, to almost 20,000 US dollars. So, and this is something might seem unachievable at this point of time. But when you look at the history of last 2 decades, the journey has been something similar, where India's economy today at $4 trillion US dollars was sub-trillion dollars a decade and a half ago. So, yeah, to your question, to be direct, whether it is a superpower or not is something time will tell. But it is definitely more relevant from an economic point of view than ever it has been. And that's something which we would like to focus on.
Yeah. Last year, India has underperformed emerging markets. What were the driver for the underperformance, Colin?
I think there was currency was a big part of that. So we had an unusual year in terms of rupee depreciation against the dollar, and even more so against currencies like the Swiss franc. I think objectively the currency is pretty cheap now. If you go to India, you'll be surprised just how cheap any kind of locally produced good or service is when you're going there with hard currency. So I feel like possibly it's overshot a little, and we may see this year more stability in the currency compared to last year, and that could be good for returns. Also, last year, don't forget, we had a very unpleasant external shock in the form of Donald Trump's 50% tariffs, when everyone expected India to come to a trade deal with the US relatively quickly, but that was postponed until just the last month or so. So we had a lot of outflows from foreign investors last year, in large part triggered by the tariffs. And now that they've come to a deal, we're starting to see money coming back into the market from foreign investors.
Yeah, Nilang, do you agree regarding the drivers of the underperformance? And you can always just raise your hand if you want to say something.
No, I think as my fellow panelist Colin has rightly mentioned, trade deal uncertainty was one definite factor which led to some sort of underperformance and foreign investors being a bit more jittery than what normally they are. But I will just add a couple of more reasons we think India did underperform last year. And it was the starting valuations. So when you started last year, India was one of the most favored markets globally. Valuations for MSCI India were upwards of 25, 24 times forward earnings. And all within that, small and mid caps were even more richly valued, which meant that market expectations on earnings growth was quite high. And as the year progressed, the earnings did disappoint compared to where we were. Let me just highlight here that despite the disappointment, we will end the year at almost 7 to 8% earnings growth, which compared to a lot of emerging markets is quite good. So we did deliver earnings, but they were lower than what it was expectations were. So I think that drove, some kind of underperformance, high valuations at the start, bit of earnings disappointment. And lastly, I guess, as you know, what has worked in since the DeepSeek movement has been AI and AI-related trades, especially among the emerging markets like Taiwan, Korea, which have been benefiting from this. As of now, India does not have a direct proxy or a direct play on AI. And as investors flock to that theme, definitely India would be one not as favored. So I think combination of these factors was something which, led to India's underperformance last year. And I just want to highlight the number. In the last 12, 13 months, underperformance to emerging market is now upwards of 40%. It's the steepest underperformance in 30 years. And despite this underperformance, last 5-year returns, India still stands very high. So India has outperformed emerging markets and China by upwards of 40%, despite this underperformance. So yes, obviously there is a hiccup in terms of returns, but the longer term, what India has delivered on the high is been quite spectacular.
We will also come back to AI. And Colin, you already mentioned more stability this year. So Nilang, which kind of further development do you expect going forward?
I think the government and the policymakers through last year have been quite proactively tweaking their policies to become more growth oriented. As post-pandemic, we saw a steep increase in the GDP growth, and there was a time to slow down the economy, and hence policymakers and central bank were a bit tight, which they started to relax last year. So Indian Central Bank cut interest rates by 125 basis points, which was the steepest interest rate cut outside of crisis like COVID or global GFC. Government went ahead and did bold reforms related to GST, goods and service tax, where they brought down the rates on most products. So I think lots had been done. And what we saw recently in month of February, we have our annual budget in India, which gets presented. And the policies there were quite growth oriented and new sector oriented. So just to give you an example, government introduced a 20-year tax holiday for any company which is setting up data centers in India. And this coincided with Google announcing a $15 billion investment for a data center hub into India, followed by Microsoft and so on and so forth. So I think what is happening now as we go into this year, some of the policies which were taken, the steps which were taken in last year will start playing out in terms of having its impact on the economy. And parallelly, government is continuing with its reform measures and especially focused on new sectors, which is related to AI, which is related to solar, battery, and so on and so forth. Yeah.
So let's talk also about AI. Where does India stand in terms of AI? Is India the anti-AI market?
Some people have begun to talk about this theme just simply because there's less exposure to AI capex in terms of India's listed companies. That's obviously been a bit of a disadvantage over the last year and a half, but it could be if it turns out that AI is suffering from a period of overinvestment or perhaps a discrepancy between the revenues that it's generating and the amount of capital spending. If there is a bubble, then I think India would be relatively less exposed to it than perhaps the US, where you see a lot of AI-related companies are trading on very high valuations and not necessarily generating the kinds of returns on capital that we would need to sustain those valuations. But nevertheless, I think India will benefit a lot from AI. What we've seen with a lot of the headcount cuts in developed countries is that it's almost a disguised form of outsourcing. So a lot of jobs are added in India because it's more cost effective to employ someone in a GCC or a global capability center in somewhere like Hyderabad, especially when their efficiency is enhanced with AI. Than to employ a very expensive person in somewhere like New York or London.
Nilang, how do you see this? How can India play a part in the AI revolution?
So as we speak, just last week, India hosted its AI summit, and who's who of the tech world were there, from Sundar Pichai to Microsoft's Satya Nadella to everybody. And there was a big focus on AI from the government side. OpenAI was there. So AI is very important from the government's future policy making in India, and a lot of measures are being taken to include AI into various aspects of policy. If just to go back a bit, India has actually pioneered digital public infrastructure. So while in Western world we have seen a lot of digital infrastructure created by private companies and held by private companies, in India's case, government actually took the first step of creating its own digital infrastructure through payment rails, through identification, through using biometric, and so on and so forth. Now they're trying to replicate the same with the AI, where they're encouraging government-led projects to create their own language processing models and so on and so forth. If you go by the surveys like IMF and some of the external agencies which have done, which actually places India pretty high on the AI preparedness, around 8. In fact, IMF's also projects that India's GDP growth could improve by almost 0.8% if AI is included from a productivity point of view. But just now talking about markets, which we all are interested. So I guess depending on the time horizon one is looking at, in short to medium term, India is like an AI hedge because India does not have a direct exposure. But if you take a longer term structural view, I think AI will be big supportive of growth in India. And like a lot of other technologies, if you see, India is a late adopter, like mobile phone and internet and digital payments. But today it is the largest market for retail digital payments in the world, even ahead of China. If you look at in India today, the mobile penetration as well as mobile cost of broadband or internet is lowest in the world. So with this, and today if you look at AI users, the largest users for ChatGPT, Claude, and Gemini are in India outside of the US. So the productivity gains which will come through by using these applications will be staggered, while in the short to medium term, India might seem like an anti-AI or an AI hedge.
And which sectors besides AI do you see the most potential? Nilang?
From our perspective, we like financials a lot in India, and not just the banks, the lenders, but in India's case, now financial sector is broadening out. So we have insurance companies which are listed. We have asset management companies which are listed. So in India, the big trend which has been going on for last couple of years has been financialization of savings, as Indians move away their savings from physical assets to financial assets. And within financial assets, they move from deposits to equities. So exposure of Indian households to equities has gone up from 5% of their financials of their savings to now 10% of the savings. So as a result of that, what has happened? Last year, while foreigners withdrew $19 billion of Indian markets, domestic investors invested $90 billion into domestic equity markets. So we are playing this theme through asset managers like ours. They're listed asset management firms in India. So that's a big theme in financials, what we like. Exchanges. So commodity, there are now exchanges which are being listed, and that's the other theme what we like. So there is a range of financial exposure which is available, and these are great proxies of what's happening in the economy and the consumer as well as the investment cycle.
Which sectors do you focus on, Colin?
We also like financials, but more specifically, we like the state-controlled banks. And this is quite unusual because typically most global investors don't like any kind of state-controlled enterprise. But we think in India things are a bit different. These companies are much better run than in other parts of the world. And I think that is essentially due to the institutional framework and the good governance in India. And consequently, the state-controlled banks have even been earning higher returns on equity than the private sector banks, and yet you can buy into them at a much lower price to book ratio. So we've been very overweight them the last 5 years or so, and they've outperformed quite strongly. But we think there's still a lot of room to go. Some of these banks are trading on pretty close to book value, even though they're earning ROE in the tune of high teens, some of them more than 20%. So we think that still has room to run that theme. We also like healthcare as a sector. We think India's healthcare spending as a percentage of GDP is only around 3%, which is perhaps a quarter of the level that you would see in Europe. So we think over time, people will spend a lot more on healthcare. There will be a lot of the government's policy seems to be as a payer rather than a provider of healthcare, which is of course very different to what you see in places like the UK, where the state is the main provider of healthcare. But in India, the hospitals business is a private sector business. It's mostly cash payers, and these businesses are run for profit, and they make very good returns. And we see, some of these hospital companies may grow their earnings by more than 30% compound over the next few years, just because they're adding so many beds, raising prices, and also improving the quality of the mix. You see some of them have introduced really state-of-the-art equipment in their hospitals, and they're attracting medical tourists from all over the world because they're able to provide the top-end services that you would come to expect in say Europe or the US, but at a much more affordable price.
And any other sectors that are not on top of mind in the markets with investors?
Energy, I think. So in most of the world, people are not really reinvesting in refining capacity. So this is why refining margins have been it's one of the reasons why refining margins have been relatively strong, is simply in places like the UK, they're even shutting refineries. And yet we haven't got to a point where global oil demand is falling materially. So the margins for people who are investing in refineries are much better, and particularly in India, it's one of the few places where people are building new refineries. For example, HPCL, they're just finishing off a new refinery in Rajasthan. and they're also upgrading the existing assets. So we see these stocks are extremely cheap, particularly the state-controlled refiners. They run very well. They deliver good returns on invested capital. They're actually superior to some of their private sector competitors. So we think that's a very interesting area of the market, and it's certainly one that's done well for us over the last couple of years.
We already talked some about opportunities. Let's talk about it some more, and also about risks. Nilang, you already talked a bit about what has been achieved, and maybe you can say a few words more about what has been achieved, or maybe also regarding trade agreements, impact of trade agreements.
Sure. Yeah. So before I dwell into that, I just wanted to add to the sectors we like as well, which was something which is we've been looking at and liking it for a while, is real estate in India. So in real estate cycle in India, unlike what's happened in China, went through its consolidation phase between 2015 and 20. And now we are seeing a structural improvement in real estate demand, both residential as well as office space. So as more and more global companies look to set up their offshore centers in India, demand for office space is increasing, which is at a record high actually. And at the same time, that as job creations are happening, there is increasing demand for residential space. And luxury property in India is also doing extremely well, as India is minting new billionaires every year. So today, as we stand, India has third number of largest billionaires in the world. In fact, in last 5 years, it has seen the highest growth of billionaires. And as a result, the demand for luxury property in India has increased dramatically. And there are only handful of players actually who are in that space. So the competition is also very less. So we've been liking real estate as a contra play in our portfolio for a while as well. Just moving forward, I guess what India has achieved in terms of policies, I guess the focus on macro has been, and macro stability has been a key achievement of this government. And that actually won India a sovereign rating upgrade from S&P a couple of months ago. So in terms of fiscal deficit, in terms of inflation focus, today we are having inflation which is below central bank's target. We have current account deficit, which is from being at 4% is now down to below 1%. Our foreign exchange reserves are at all-time high. So there's a lot of macro stability which is available. So which is helping India, withstand some of these shocks which have happened. So that's one big achievement. I would say it's a bit underappreciated. So when people put India in the bucket of emerging markets, but when you look at the macro stability measures, actually it is more like a developed market. Having said that, the other achievements which the government has done in last few months has been closing the trade deals. So it started to close trade deal with the UK. It followed up with the trade deal with EU, which was under negotiation for last 19 years. And finally, it also concluded the trade deal with the US. So that just shows the proactiveness of the government as well as willingness to, sit on the table and get the job done. I think that's something which is also a great achievement to be talked about.
What stands out for you in terms of development in India, Colin?
I think what's really been very impressive is the government. I mean, I almost wish that we would have the same Prime Minister in the UK, where we've had such huge turnover of people who just decide one thing, then change their mind. But in India, there's a real strategic focus on what needs to be done to make continue growing the economy at the 6% rate, 6 to 7% rate, so it's not just that they did a lot of very good reforms to counteract the external shock from the Trump tariffs. There's real investment and encouragement of the building out of new industries. They have, for example, a thing called production-linked incentives, where the government is essentially committed about $26 billion over a long period of time which they're going to subsidize the capex of companies in sectors like solar energy, electric vehicles, electronics assembly, all of these things that will be very important for the next 10 or 20 years, and where companies already want to invest because they can see that there's a need to diversify supply chains away from China, and the government is really helping to get that going. So in some cases you find that you need to have a network of suppliers. You need to build, for example, the capability to build solar modules and then cells and then integrate upwards into ingot wafer. And the government is essentially making this much more achievable and accelerating the investment and ensuring that there's a market for these goods by making sure there's domestic content requirement. So it's a long-term strategic thinking, which I think is what is the most impressive thing really about the story.
And in terms of people and workforce, what are the strengths in India?
I think they produce a large number of science and technology graduates. So there is it gives a big competitive advantage in terms of services. It's one of the areas that they've historically been very strong in. But also I think from a relatively smaller base, manufacturing will become increasingly important because the labor costs are so much more competitive than other parts of the world. As soon as you get these supply chains built, and as soon as you have these clusters of component makers, then you can do a lot more manufacturing and increase exports, and that's, I think, will be a big growth area over the next 5-10 years.
Let's also talk about risks that are still remaining. Who wants to go first? Nilang?
Sure. So I guess we are in a complex world where past rules are being rewritten, and geopolitical alliances are being rebuilt or realigned in some sense, and India will need to navigate this very carefully and to its advantage, so I think that's a big challenge of how India will be able to navigate this is first. Second, from a medium to longer term perspective, while India has lots going for it, primarily from a demographic point of view. So India is the youngest country in the world with 29 years, or one of the youngest countries in the world with average age of 29, with the working population which will keep growing till 2040. India will need to find jobs for these young people who are coming into the workforce. Right now, large part of India's workforce, 60% of the people are occupied in agriculture, and agriculture is only 20% of GDP. And hence that part of population is extremely unproductive, or they need to be upskilled and they need to be got into the mainstream. And that's where what my colleague talked about earlier, Collins, about manufacturing, focus on manufacturing, creating manufacturing jobs is going to be very critical. And that's something which, so just to give you an anecdote, yesterday in Singapore, the chief minister of India's largest state was here on a investment roadshow, and he was saying his state is going to be $1 trillion economy in next couple of years, and he was showering many subsidies and many incentives for Singapore companies to come there and invest. So that's the kind of proactiveness, like investors go out on road shows, the state provincial leaders are going out, which is very, very, very interesting. But from a risk perspective, I think it's a geopolitical navigation which India needs to do, and creating jobs for this growth to sustain.
Yeah,
Colin, what are the main risks in your view?
I think one risk, of course, is climate. So if we see already that the weather is becoming a lot less predictable and a lot more extreme in places. I was in Austria a couple of weeks ago, and the first week it was like the spring, and then the second week they had half a meter of snow. So there's a lot of volatility, and for an economy that still has a lot of exposure to agriculture, that could be a risk in the long run. But it's a risk that I think we'll be able to manage in various ways, in improving storage of water reserves, and also as more of the population move away from agriculture and into manufacturing or services, then that will help to mitigate some of the risks. Other than that, I think one of the downsides, as it were, of having such good government that is generally well liked by investors is the fear that there could be a change of government at some point in the future. Now, we don't need to worry about that for quite a long time, because the current government's term runs until 2029. And the state-level elections that we've had suggest that they remain broadly popular. They've been generally winning almost every election. But to my mind, so I think that the way that investors tend to think, they would be very concerned initially if there were a change of government in the next election. I don't think that's the most likely scenario. But I think if it did, it wouldn't matter too much. So we did an analysis of stock market returns during both the government, the BJP government of early part of this century, and also the Congress government that came after it, and the BJP government after that. And we found that actually the stock market has gone up through all of these periods. So I think it's a bit different to other countries in that, in some places like certain European countries, there are very extreme parties who would do something silly if they got into government, and it would cause problems. But in India, I think the opposition is more moderate and not wouldn't upset the apple cart to the extent that you would see in Europe. So it's something to keep an eye on, but I don't think it's something that in the long run ought to be a concern.
Yeah, we could talk more, but I also want to give the audience the chance to ask questions. If there are any, I would say here, and please do wait until the microphone comes, and please say your name.
My name is Søren Bjørnes. I lived in Nepal, so next door, so to say, to India. There's been lots of discussion now about the desirability of manufacturing, and you're alluding to that manufacturing will be a growth sector in India. For me, it seems like services is the cutting edge of India, and where they really have a competitive edge versus, very hardworking Chinese manufacturers. But that's not such a productive sector. So you don't have the same productivity gains like you have in manufacturing. Will that be a little bit of a trap for India? What do you think?
I think the relative the cost of employing people in China has gone up very significantly over the last 20 years. So initially it had that cost advantage against the rest of the world. Now India is clearly in the number one most competitive place in terms of labor cost. What held it back previously was difficulty of doing business, so bureaucracy and bad infrastructure. The infrastructure problem is being solved very rapidly. If you travel, say, to Mumbai, it's just impossible to miss the huge number of roads they've built, motorways, airports. They have a new airport being built in Navi Mumbai. So the infrastructure is improving, and the ease of doing business is also improving. So in the autumn, they brought in a new labor code, and they cut the number of regulations that businesses need to comply with from 1,500 down to 400. So the government is really focused on making it easier to do business, and I think, obviously China it has a big advantage in terms of its efficiency and manufacturing. The breadth of its manufacturing industry, but the world has become overly dependent on it, and there is real resolution from most multinational companies to have a China plus one strategy, where they get some of their supply chain is filled through India. I mean, you look at Apple, for example, the iPhones. They previously used to make almost all of it in China, and now an increasing percentage is being made in India and being exported as well as being consumed locally. So I think the direction of travel is quite clear, and it's one of improvement.
And Nilang, anything to add?
No, I think, yes, India has underperformed or disappointed on the manufacturing side. So for the size of the economy, manufacturing is underrepresented. the whole focus on Make in India, ease of doing business, and the whole PLI scheme is changing all of that. It needs to gain more momentum, and directionally, as I was mentioning, the current budget had a lot of measures, small measures, which were taken to increase the manufacturing aspect, and especially in the new sectors like critical minerals, battery, EV technology in India, and so on and so forth. So I think the government is putting in place, but yes, it's not going to be easy considering scale at which China operates. And though India has lower cost of labor, the productivity adjusted labor is not as good as what it seems. So, but the directionally, we hope it gets better.
There has been more questions. Yeah, thank you. Please wait for the microphone. Thank you.
Hi, my name is Ari. Thanks for the presentation. I'm curious to the point both of you made. So very clearly you have this sort of 4 billion of monthly SIP inflows locally, sort of counterbalancing the foreign outflows. Do you feel that is now structurally strong enough that if you were to have, say, a risk-off moment domestically, that it can sustain? Or does the domestic capital become like the foreign capital used to and you start seeing cyclicality?
What we've seen so far is Sorry, do you want to take this? No?
It's a great question, and I think this is something which we ourselves, try to analyze and debate. There are some things do give comfort. In last few years, there have been massive external shocks. There have been shocks through like pandemic. There have been shocks post that with the tariff and elections as well in India, there was sometimes disappointment. And through these external or internal kind of shocks, the SIP flows have only remained strong and increased. Having said that, obviously, I guess incrementally we are at levels where there has to be some sort of normalization of these flows, but it's unlikely to go back to swinging like external flows would be. So just to give you a number again, 10 years ago, household savings, 50% of household savings were in bank deposits. Now that number has come down to 42%. So with interest rates in India now structurally on the lower side, the financial savings options with households is limited to, equities has become an attractive longer term place. So we do expect this to continue. But it will be in a range, is what we think. Sorry, Colin, for you.
Yeah.
Yes, I generally agree with everything you said, and it has been very impressive that the domestic investors have been consistently very. Been very stable in their commitment to the market, and they haven't really panicked in the way that you might have seen, a decade or two ago. I think, and a large part of that is because of the systemic investment plans. Because when you have a habit of putting a certain amount in monthly, amount that you can afford, you don't tend to pull it out in the same way that you would if you were putting in, speculatively a big lump of capital at once. So I think it's stickier money than we've seen in the past.
Thanks.
Thank you.
Yes, I just wanted to add to this point because it's a very interesting point on flows. As we have seen this, we have also seen foreign institutional investor ownership of the Indian market is at almost 15-year low. If you look at global funds, their allocation to India is at 20-year low in terms of their overweight. Now, most global funds are underweight. If foreign investors have to go back to their 10-year averages of the Indian ownership, what they've had, they might need to invest at least $130 billion into the Indian market. So India is currently, even if there is some slowdown in the domestic flows, foreign flows could change if things change around. So that's another point I just wanted to leave with. Yeah.
Thank you. Go ahead, please.
Coming back to the risk topic, you both mentioned potential risks of more longer term, such as climate change and demography. Looking at the shorter period for, let's say, 1 or 2 years, Which are the major risks you see, and what do you recommend to mitigate these risks?
It's a good question. Sorry, go on.
Sorry.
Yeah, go ahead, Colin.
I think over the last year, as I mentioned, the currency has been a bit of a swing factor. I think that's less of a risk this year. I think one potential risk could be to do with the rate of the improvement in earnings. So I think we will certainly see earnings growth accelerate going into the next financial year. Some expectations may be getting a bit on the high side. I think it's reasonable to expect mid-teens earnings growth, simply because there'll be such a tailwind from the normalization of bank earnings. But I think some of the sell-side analysts that I've seen are putting out figures as high as 19%. So it could be one risk could be that the pace of acceleration in earnings growth, whether that matches expectations, is going to be quite important for the direction of the market. But I think overall, the big swing factor will be to what extent foreign investors come back, because I'm fairly confident that Indian investors will continue putting money into the market. It's a very optimistic country. People really believe that the economy will grow at a good rate, and that then they will make money in the stock market. But the foreigners are a bit of a swing factor. We've started to see inflows this month on the back of the India-US trade deal, which is what frightened them away last year when it didn't happen as soon as expected. So I think the expectations, whether they can fulfill the expectations of accelerating earnings, and also to what extent foreign investors return to the market, may be affected by things happening in other parts of the world. To my mind, a lot of the markets that might compete for their attention have gone up a lot. Places like Korea and China, they're not as cheap as they were a year and a half ago. So it's possible they will come back to India because, of course, it has, in my view, a superior long-term growth outlook. But the pace of what that, at which they return, and the volume of what they buy is, of course, difficult to predict.
Nilang?
I guess, from a medium-term perspective, I think earnings is a key disappointment risk. If earnings disappoint, that could be something to worry about. The other trend which does worry me a bit is increasing populism, what we are seeing when we look at state elections. So while central government has been very prudent and very disciplined, when states are going on with the elections, they're becoming a bit more populist. And that could increase some pressure on the fiscal side for the provinces, and that could put an indirect pressure on interest rates with bond yields going up, and that could start. But this is like a medium-term risk, which I would be watchful of. Yeah.
I think we have time for one more question. Yeah. Please pass over the microphone. Thanks.
Yeah, my name is Peter Uli. I'm wondering what the risks are from the neighbors. Pakistan is constantly in conflict. Bangladesh seems to be more in conflict now. And it seems to be somewhat unstable. And this is certainly a concern.
Well, I think people worry about that, and with good reason, but the reality is that India and Pakistan have fought many small conflicts over the last few decades, and it hasn't interrupted the rise of the Indian stock market. And the reason for that is that these skirmishes tend to be quite short in duration and limited in scope. And the reason for that is, of course, both countries have nuclear weapons. India has perhaps the superior delivery systems, and I think that is what motivates both countries to keep things limited and to come to some sort of settlement after a short conflict. And if you have short conflicts, typically they don't affect the economy, and consequently the stock market is not affected. The other risk, of course, is whether there will be conflict at some point with China. There have been some small skirmishes over the borders, but I don't think China seems to be very interested in these border areas compared to other things like Taiwan, which seem to occupy their attention a lot more. So I think if anything would go wrong in that area, it would be more likely with Taiwan than with India, where at the moment we actually see improving relations with China, resumption of flights and easier visa access. So they seem to be have mended their fences a bit and are getting on better at the moment.
Nila, you agree?
No, I guess what's happened in Bangladesh did surprise a lot of India watchers for a long time, and that's at the margin been an incremental negative. But I guess Prime Minister Modi immediately reached out to the new administration and has invited them to, normalize the relationship with Bangladesh, which is something is positive from where we were. But I guess which I said in my earlier comment on risk, it's how India will navigate geopolitically in coming is going to be a very important part of how longer term things will pan out. And that's something which we'll be watchful of, yeah.
I think we have to come to an end. I think we covered a lot, and let's see how it goes. And thank you so much to our panelists, and also thank you so much to the audience for coming and your participation. Enjoy your lunch.
Thank you. Thank you so much. Have a good day. Bye-bye.
Thank you, Milan.
Finally, the mandatory risk warning. The content of this episode is for general information only and is not a recommendation to buy or sell any financial products. All information is supplied without guarantee, and this is not an investment advisory. New episodes are released every Tuesday and Thursday.